This is Josh, and today on the Infographic Show, we're going to talk about why OpenAI will run out of money, but not for the reason you think. The creator of ChatGPT looks like the king of tech with $20 billion in revenue, but internal spreadsheets reveal something startling. Starting in 2026, they face projected losses of $14 billion annually. By 2029, cumulative spending could hit $115 billion. The product works, but the bills are tied to expensive, real-world constraints. Here's the thing that most people miss. The massive losses lie in a simple fact. AI is not just another app, and it behaves unlike any software we have ever built. In the traditional software world, if you want to make a better app, you hire better engineers. You write cleaner code. It's a human cost. But AI doesn't work like that. It works on something called scaling laws. These are mathematical rules that govern how AI gets smarter, and they are incredibly expensive. The rules are simple. If you want a model to be, say, twice as good, you can't just double your effort. You have to ramp up computing power by a lot. It's basically a brute force equation. Small gains in intelligence mean massive spikes in capital. It sounds crazy, right? But wait until you see the numbers. Training GPT-4, the model that really kicked off the revolution, cost roughly $100 million in computing power. That is for one full training run, which is the process of teaching the model from scratch. For a big tech company, that is expensive but manageable. The next generation, the frontier models arriving in 2026 and 2027, play by different rules. Each run could cost over $1 billion. We have reached a point where a single training session for one AI model costs more than the GDP of some small island nations. And it gets worse. You can't just train it once and walk away. You have to keep on doing it. OpenAI is trapped in a cycle where they must spend these billions of dollars just to stay slightly ahead of their rivals who are giving similar tech away for free. This creates a fundamental gap in their business model. Their costs are tied to physical realities, electricity and silicon, which are expensive and scarce. But their ability to raise prices is limited because there's so much competition. The math is simple, and it is catastrophic. Explosive costs are outpacing revenue, and the money is running out. And the financial bleed gets even worse. To do the heavy lifting, OpenAI needs high-end AI chips like NVIDIA's Blackwell B200s. These aren't your typical CPUs or GPUs. Each one runs $30,000 to $40,000. And you can't buy just one. To train a frontier model, you need a cluster. That means tens of thousands of these chips, all wired together with high-speed links and liquid cooling systems. And this is where the costs really start to pile up. But the problem isn't just buying the chips. The problem is that these chips have a limited shelf life. Unlike a machine in a factory or a delivery truck, which might run for 20 years, AI hardware doesn't last. It becomes outdated the moment the next generation of chips hits the market, and then companies are playing catch-up. OpenAI has to replace their entire system of chips roughly every 18 months to 3 years just to stay competitive with Google and Meta. Imagine a trucking company having to buy a brand new fleet every 18 months because the old trucks suddenly can't deliver packages fast enough. That is the economic reality of AI hardware. This means the billions of dollars OpenAI spends on hardware isn't a long-term investment. It's an expense that disappears. The value of that hardware drops fast. But if the cost of the chips wasn't enough, there is another bill that's starting to look even scarier: the electric bill. This is best illustrated by Project Stargate. It's described as just a big new supercomputer, but it's actually a $500 billion gamble. $500 billion. Yeah, that's right. To put that into perspective, 10 gigawatts could power millions of homes. It's the equivalent of multiple full-scale nuclear reactors just for this one project. Why does this matter? Because the costs aren't going away, and the grid can't keep up. The scaling costs aren't going away, they're fixed. You can't build the next generation of AI without this level of power. The bottleneck isn't just the cost of electricity, it is the national grid. Getting enough high-voltage transformers and grid capacity is a huge hurdle. The old utility system can't grow fast enough to keep up. So OpenAI is now in the position of negotiating for direct access to nuclear power and massive solar farms. These utility costs create a high floor for their operating expenses. Every free ChatGPT user is literally costing billions, and there is no way around it. It makes it nearly impossible to maintain healthy profits when you are trying to offer a free tier to hundreds of millions of users. Every time someone uses ChatGPT for free, OpenAI has to pay for the electricity and the silicon wear and tear. So if OpenAI is losing billions of dollars on chips and electricity, how are they still open? How do they pay their employees? And that leads us to one of the most misunderstood pieces of the OpenAI story: its deal with Microsoft. We often hear that Microsoft has invested billions into OpenAI, and on paper, it looks like billions came in. In reality, it's more like a financial merry-go-round that hides how tight the startup's cash really is. When Microsoft invests billions, a lot of that money doesn't actually leave Microsoft. They give OpenAI cloud credits instead, sort of like a gift card. And you might think that that counts as real cash. It doesn't. OpenAI can record it as capital raised, so it looks like cash, but the credits have to be spent on Azure, Microsoft's cloud service, to run their models. This effectively recycles the investment back into Microsoft's revenue stream. It boosts Microsoft's cloud earnings and stock price. But here's the dangerous part. You cannot pay your employees with cloud credits. When OpenAI hires a top researcher for $2 million a year, they need hard cash. When they have to pay for office space or legal fees, they need money. This creates a financial optical illusion. Microsoft invests $10 billion, but that money doesn't actually land in OpenAI's account. It's basically digital coupons that can only be spent on Microsoft servers. The result is massive pressure. Every fiscal quarter, OpenAI has to raise hard cash from other investors just to pay payroll and cover bills that Microsoft credits can't touch. If the flow of new outside investment slows down, OpenAI faces a cash flow crisis. They might have plenty of computer time, but not enough hard currency to keep their team from leaving for rival companies. Despite all those costs, investors keep on pouring money in. In March 2025, OpenAI managed to raise $40 billion, the largest private funding round in history, even bigger than the IPO of the oil giant Saudi Aramco. But here is what is really odd about it. Saudi Aramco has hundreds of billions in revenue, and more importantly, it has real tangible assets, oil reserves that you can measure and sell. OpenAI is a startup with no profits, burning cash at a rate of billions a year. Its value is mostly intellectual property, which anyone can try to copy. So what does this mean for the long-term survival of OpenAI? The answer will surprise you. Investors are pouring money in based on the promise of a market that doesn't fully exist yet. For OpenAI to be worth $1 trillion, it can't just be impressive, it has to replace dozens of cheaper tools that companies already use. Right now, most businesses spread their AI budgets across multiple smaller providers, not just one giant system. OpenAI is building something massive and expensive, betting that eventually everyone will need it. But right now, there's no guarantee of that demand. And this leads us to the risky business model. In software, companies survive by making it hard for customers to leave. Salesforce does this because moving all your data is a huge pain. Netflix does this because they own shows that you can't watch anywhere else. OpenAI is discovering a hard lesson. Users are mercenary. If Google's Gemini or Meta's Llama offers a similar answer for cheaper, they'll leave instantly. About 75% of OpenAI's revenue comes from consumer subscriptions, but the number of cancellations is rising. And once the novelty fades, most users won't pay. Big business is even more skeptical. Only about 20 to 30% are sticking with OpenAI's API long-term. Many are choosing open-source models like Llama to keep data private and costs down. With nothing keeping them tied to OpenAI, no built-in network, no way their data is stuck, they could just jump to another provider overnight. And the competition is just as deadly as OpenAI's own cash burn. Meta's decision to release the Llama models for free was not an act of charity, it was a tactical strike. When Mark Zuckerberg gives everyone access to their top-of-the-line AI for free, he effectively sets a ceiling on what OpenAI can charge. Meta can burn cash on open-source models because they're using the tech to improve ads on Instagram and Facebook. Their business isn't selling AI, it is selling ads. OpenAI doesn't have that luxury. Their only product is the AI itself. They're fighting to establish themselves while their competitors aggressively undercut the market to keep them from gaining ground. And the clock is ticking. OpenAI is squeezed from all sides. On top, giants like Microsoft and Google with practically unlimited cash. On the bottom, lean competitors like Anthropic and Mistral. Anthropic runs a much more efficient operation, focusing on safety and enterprise reliability with a much lower burn rate. Meanwhile, Google's DeepMind keeps stealing talent, forcing OpenAI to offer massive stock-based pay packages. Those only work if the company's valuation keeps climbing. If it stalls, the researchers, the company's only real asset, could walk out the door. As if burning billions, fighting competitors, and losing talent weren't enough, regulators in Washington and Brussels are circling. In early 2026, the FTC and European Union intensified their antitrust probes into the Microsoft-OpenAI partnership. Regulators are checking whether Microsoft's investment is actually a de facto acquisition designed to skirt merger laws. If they decide to limit the power Microsoft has over OpenAI or force a split, it would cut the startup's financial lifeline. And then there's the mounting geopolitical friction. Export controls on AI chips are shrinking the global market, while new AI safety regulations are creating a massive compliance burden. OpenAI now needs armies of lawyers and safety researchers, roles that are costly and generate zero revenue. The danger becomes clear when you look at history. Uber lost billions before its initial public offering or IPO, but it was building a physical network in thousands of cities. Tesla struggled for years, but it was building factories and a global charging network, something real that competitors couldn't copy overnight. OpenAI, well, it's burning billions with no real network or physical assets to lean on. OpenAI's production is all about raw computing power, the expensive chips that mostly come from NVIDIA. Unlike Tesla or Uber, OpenAI's product loses money every time someone asks it a complex question. And there is nothing stopping users from leaving tomorrow. The company is now effectively betting everything on a single desperate timeline. They're racing to build artificial general intelligence, or AGI, an AI that can think and learn like a human before the bank account runs out. This isn't a standard software business strategy anymore. If OpenAI can build a model smart enough to do the work of a human expert in any field, their current cash burn wouldn't matter. Revenue could, in theory, skyrocket. They're picturing a world where their AI doesn't just summarize emails, it replaces entire departments, handling corporate taxes, writing complex code, and planning strategic business moves at superhuman speed. Reach that milestone and they could charge a premium that covers any debt, no matter how massive. If OpenAI is losing $14 to $17 billion a year, every month of delay costs over $1 billion. If the breakthrough to AGI takes 5 years instead of 2, they'd face a funding gap of nearly $100 billion just to keep the lights on. And no investor can fix that overnight. So what happens when the money runs out? You might expect a dramatic crash, but the reality is different. The most likely outcome is not a dramatic crash or a bankruptcy filing, but a quiet absorption. By mid-2027, based on current projections, the cash reserves raised in the 2025 rounds will be nearly empty. At that point, OpenAI will face a choice: raise another massive round at a lower valuation, crushing their employee stock options, or sell. Microsoft is the natural and maybe the only buyer. They already host OpenAI systems on Azure and they have deep integration with the software. More importantly, Microsoft has over $80 billion in cash reserves, making them one of the few entities on Earth that could sustain OpenAI's burn rate. For Microsoft, this is the crown jewel, the engine of the next computing era. For investors, it's a fire sale, but one that buys survival. This is the end of the startup frontier. OpenAI proved scaling works, but only if you have a nation-state-sized budget. The AI revolution has gone industrial, where success is measured in acres of data centers, not lines of code. OpenAI started the trend, but it doesn't have the resources to compete alone. And now the independent pioneer is likely to be absorbed by a larger corporation. Now go check out Real Reason Humanity is Not Ready for AI Superintelligence, or click on this video instead.